When a factory produces thousands of identical metallic parts every hour, tracking the exact physical location of each individual unit quickly becomes impossible. Those parts travel down a physical conveyor belt in a clear, predictable line. But on a balance sheet, the money spent to make those parts doesn't travel on a belt. Financial costs are abstract figures that have to be assigned. Because identical goods are perfectly interchangeable, accountants don't try to tag the cost of a specific piece of metal. Instead, they use mathematical formulas, called cost flow assumptions, to model how those dollars move through the business. These formulas do two specific jobs. They determine how much expense to report on the income statement as the cost of goods sold, and they calculate the remaining value of the unsold items sitting in ending inventory on the balance sheet. If you buy a batch of units in January for $10 each, and an identical batch in June for $12 each, and then you sell one unit, which price tag leaves the building and which one stays? Professional inventory management relies on selecting a specific mathematical algorithm to dictate how a company's profits and assets are reported to the public. Consider a hypothetical business called Entity A. Throughout year one, they execute an exact fixed series of purchases and sales of an identical product. The physical reality of what they bought and sold is totally locked. This table shows Entity A's results under 5 accounting models. The exact same physical stock can be valued in ending inventory anywhere from $740 to $816. Because costs are fixed, reported cost of goods sold swings inversely by nearly $100. Identical purchases and sales led to significantly different financial reports across these 5 models. These dermiations are built into the mechanical application of the accounting rules. Each method applies a different chronological or mathematical filter to the same pool of costs. To see how physical goods translate into divergent financial realities, we need to reverse engineer the 4 primary models: specific identification, average cost, FIFO, and LIFO. The baseline method is specific identification. Unlike the other models, this one requires determining exactly which individual unit was sold. It is a literal map of the physical flow of goods. It is designed for items that are not interchangeable. This includes blocks of investment securities, luxury automobiles, or custom heavy machinery. To use this method, the items must possess a clear, permanent identifier. If an asset has a unique serial number stamped on its side, it is a prime candidate for a specific identification. This tracking card shows how precise the matching process must be. We don't guess which units were sold on March 15th. The records confirm they were the exact units purchased on January 12th. While highly accurate, logging individual identifiers for thousands of transactions generates massive administrative overhead. For low-cost, high-volume items, it simply isn't feasible. Because tracking individual screws or gallons of fuel is inefficient, accountants rely on 3 major cost flow assumptions to manage interchangeable inventories. The first assumption is the average method. Here, the company stops trying to tell individual items apart. All identical goods are merged together and measured at a single average cost. However, the exact timing of the calculation dictates the final number. If a company updates its inventory periodically at the end of the month, they use the weighted average method. If they track inventory perpetually, updating after every transaction, they use the moving average method. This calculation shows the periodic, weighted approach. The company waits until the period ends, totals all the purchase costs, $3,060, and divides by the 150 total units to lock in one flat rate of $20.40. In the perpetual moving average table, the cost per unit column isn't a single flat rate. Every time a shipment arrives, like on March 1st and June 1st, the software absorbs the new prices, immediately recalculating the weighted cost for the entire stockpile. Any sales that occur before the next delivery, like the one on April 1st, simply use whatever the average cost happened to be on that specific morning. The underlying purchases were identical, but by recalculating continuously rather than waiting for month-end, the company alters the mathematical valuation of its inventory. The other 2 major models abandon averages entirely and organize costs chronologically. These are first in, first out, or FIFO, and last in, first out, or LIFO. This table demonstrates FIFO. The rule is simple. The oldest goods are sold off first. That means the ending inventory on the balance sheet is always constructed from the most recent, latest purchases. Because the oldest unit in the warehouse is always the oldest unit, regardless of when you check the records, FIFO produces the exact same financial results under both periodic and perpetual tracking systems. LIFO reverses the flow. Newest items ship first. Older costs are trapped in distinct historical layers, like these January and March tiers. During the April 1st sale, the algorithm peels away the top layer, burning through March inventory before touching January stock. But a periodic LIFO system ignores the day-to-day timing. It waits until the end of the month, identifies the absolute latest deliveries from the entire period, and flushes those out as a single aggregate batch. Because what counts as newest changes depending on whether you calculate daily or monthly, a company using LIFO will see completely different profit margins based purely on the frequency of their accounting software. We now understand exactly why Entity A generated 5 different answers. The varying results stem from whether costs are averaged, layered, or stripped out chronologically. In an active economy, these mechanics serve as strategic financial tools, particularly when prices for raw materials steadily rise due to inflation. During inflation, the newest items are the most expensive. By using LIFO, a company forces those high costs into the cost of goods sold. Higher expenses immediately reduce reported gross profit, which leads directly to a lower tax bill. Conversely, if management wants to attract investors, they deploy FIFO. FIFO matches older, cheaper costs against current revenues. The lower expenses increase reported net income, making the company look more profitable on paper. This strategy has a structural weakness. FIFO pairs current retail prices with historical purchase costs, creating a distorted margin that doesn't reflect the current reality of replacing that inventory. LIFO carries its own risk. Because the newest purchase instantly hits the income statement, management can alter net income simply by executing a large strategic inventory purchase on the very last day of the fiscal period. The mathematical choice of a cost flow assumption governs a firm's tax liabilities, its reported profitability, and